Views regarding the economy, securities markets, or other specialized areas, like all predictors of future events, cannot be guaranteed to be accurate and may result in economic loss to the investor. Past performance is no guarantee of future performance. Any information is for illustrative purposes only and is not intended to serve as investment advice or as a recommendation, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Individual securities discussed may be held in accounts where JGUA and or its employees have a beneficial interest. And with that, let's get to this week's episode.
Hey everybody, Dr. B here with John G. Ullman and Associates. This is our weekly market update for the week of February 3rd. I want to thank you for joining us, and I want to invite you to like and subscribe to the channel. Check out some of the other great video content that we have, and don't forget to come back each week for these market updates. As always, my intention with these videos is to use my background in economics to help you better understand the economy, the financial markets, and make better informed financial decisions. So with that said, let's get ready to hit the books and get up to speed on the markets. Starting with last week, we'll start on the economic side. We got our first estimate of the fourth quarter gross domestic product, which came in at 2.3%. This is slightly below the 3% that economists had expected, but still significantly healthy growth. And for the year of 2024, we saw a total real GDP growth of 2.8%, which is only slightly below the 2.9% from 2023. We also saw the December report for the PCE price index, or Personal Consumption's Expenditure Price Index. This is the Fed's preferred measure of inflation, and the headline number rose from November to December from 2.4% in the last year to 2.6%. The core number, which excludes volatile areas such as food and energy, came in at 2.8%, which was the same as what we had seen in November. The importance of this information is that we've seen a slight increase in the headline inflation number since September, which is, of course, going in the opposite direction of what we'd like to see. And this data and these trends have actually started conversations among economists and analysts that we may not see any interest rate cuts in 2025, and that we may, in fact, see an interest rate increase as a result of increasing inflation. In addition to inflation and GDP numbers last week, we also saw a Federal Reserve interest rate decision. At this meeting, the Federal Reserve decided not to cut or raise interest rates, but to leave them stable at the same level. If you've watched our market updates prior to this one, you knew that this is what economists and analysts had expected. The Federal Reserve continues to be optimistic that inflation is headed down towards their 2% goal, but reiterated the fact that interest rates will most likely stay higher for longer as the battle has slowed to bring inflation down to the level they desire. We also saw important housing sector data released last week as the Case-Shiller Home Price Index suggested housing prices had increased by about 3.8% over the last 12 months. New and existing home sales increased by healthy margins, with existing home sales increasing the most that we've seen since June of 2021. These home sales have increased despite the high interest rate, high mortgage rate environment. And at the same time, we've seen the supply of homes for sale increasing over the same period. Switching over to the stock markets, we saw a huge dive on Monday as information about the new Chinese AI competitor known as DeepSeek hit the mainstream. The S&P 500, within the span of one day, lost over $1 trillion in market value, and we saw specific big-name tech companies, including NVIDIA, Broadcom, and Oracle, lose more than 15% of their share price in one day. Now, with this said, we did see a partial recovery on Tuesday as more information and more understanding was developed about the role that DeepSeek will play in the global AI infrastructure. And as the week progressed, we saw a prolonged recovery of the majority of the losses experienced on Monday. As the week progressed, the impact of DeepSeek on the tech sector and the stock market transitioned from panic and hype to understanding and speculation. Some of the key talking points surrounding the introduction of DeepSeek, which is a tool similar to ChatGPT, is that it was developed using a fraction of the expensive microchips required for other AI tools. It was developed in a way that makes training and preparation more efficient, and that it supposedly requires only a fraction of the amount of energy that other AI tools have required. One additional piece of information that makes DeepSeek a unique tool is the fact that it is currently open source code, meaning that instead of a single company developing and enhancing proprietary code, the code is made available publicly to developers, and it is improved in a cooperative and collaborative manner. These DeepSeek developments were definitely a wake-up call for both investors and innovators, but despite the dramatic information and the significant response on Monday, in the long term, we haven't seen any of the major US AI players change their strategy or spending plans in response to the introduction of DeepSeek. In fact, Facebook and Microsoft have explicitly stated that they continue to plan to spend more on AI-related investments in 2025 than they had in 2024. And several companies mentioned they will continue to make major investments in both data center and AI tool development. Although the introduction of DeepSeek may act as an improvement or an enhancement, bringing down the costs of AI development and tools, it does not seem to have changed the overall trajectory of the AI sector or the tech sector more generally. Switching over to fourth quarter earnings reports last week, we saw mixed results, with some large companies such as Boeing, Lockheed Martin, and General Motors all missing expectations and their stock price taking a hit because of it. We also saw companies like Meta, Apple, Visa, and MasterCard exceed expectations and stock prices rise in response. And in addition, we saw some companies such as Tesla and Microsoft who underperformed expectations. But while Tesla was able to maintain a stable share price throughout the week, in spite of that, Microsoft's share price took a hit as there was some speculation about their weakened cloud services revenues. Last week, we saw the yield on the 10-year Treasury note fluctuate between 4.5 and 4.6%, taking a bigger hit at the beginning of the week on Monday, posting a slight recovery on Wednesday following the Federal Reserve's interest rate decision, but again falling and ending the week closer to 4.5%. We saw another exceptionally volatile but becoming typical week for Bitcoin as it fluctuated between 98,000 and 106,000, never quite gaining traction in either direction and responding quickly and aggressively to changes in the news cycle and information about the remainder of the stock market. The price of crude oil and the value of the US dollar both dropped throughout the week, although the value of the US dollar recovered a bit on Wednesday following the Federal Reserve's decision not to cut interest rates, and as well as Friday following the European Central Bank's decision to cut interest rates, thereby making the value of the US dollar greater. The price of gold steadily increased throughout the week. Although we saw a big jump starting Thursday, many analysts speculate that the increased interest in gold is in response to the Trump tariff threats, as well as the increasing volatility as a response of changing Trump policies. The fourth quarter GDP report came in below expectations, while the PCE inflation continued to demonstrate a possible resurgence of inflation in the economy. These two factors combined also creates a possibility for stagflation, in which case the gold market traditionally performs exceptionally well. Last of all, we have to talk about tariffs. As promised, at the end of last week, the Trump administration implemented several tariffs on several of our major trade partners, including Canada and Mexico. Although the long-term impact of the retaliation for these tariffs, as well as the legal challenges of these tariffs, isn't known, what we do know is that the global economy is now on edge, and that as the Trump administration follows through on at least some of its tariff threats, the global economy is taking notice, and the trade situation continues to unfold. Switching our focus to the upcoming week, this week we'll again continue to see more of the fourth quarter earnings reports. In fact, we'll have over 130 of the S&P 500 companies reporting this week, including some major companies such as Google, Amazon, PepsiCo, the Walt Disney Company, and the Ford Motor Company. In addition to those major names, we'll also see the top materials company in the S&P 500, Linde plc, sharing their fourth quarter earnings. Additionally, we'll see some major healthcare players releasing their fourth quarter earnings reports, including Merck, Amgen, Pfizer, and the Eli Lilly Company, as well as some major energy players in ConocoPhillips and Marathon Petroleum. On the economic side this week, it's going to be another week of jobs, as the job openings and labor turnover survey is released early in the week, the ADP employment report around the middle of the week, and the national unemployment report on Friday. Economists continue to monitor the number of jobs added, the sectors that are gaining and losing jobs respectively, and the number of job openings relative to the number of unemployed workers at this point. We'll also see preliminary estimates of consumer sentiment for the month of February, with all eyes paying very close attention to consumer expectations of inflation. Looking further ahead into the future, we'll continue to watch the inflation reports, as a resurgent inflation could significantly change the trajectory of the U.S. economy in 2025. We'll also continue to monitor the rest of the fourth quarter earnings season, as next week we'll have about 60 of the S&P 500 companies. The following week, we'll begin to close up with about 50 of the remaining companies. As you can see, there's a lot going on in the U.S. economy, the global economy, and financial markets. But fortunately for you, this is where our weekly market update is the most helpful. We can take the time to read through the headlines, sift through the reports, and analyze the data to bring you only the most useful information in an easy to understand format. And in fact, this is exactly what we do best. We take the time to read all the reports and understand what's happening, so that way we can keep you up to speed on the markets and allow you to make informed financial decisions. So with that said, thank you for joining us this week. Good luck this week as the economy and the markets unfold. And don't forget to come back and join us again next week.